We've had some decent economic data from the US today, which has given the US dollar a bit of a bump in early trade. Now, this is a selection of data on the US economy, the strength of the labor market, and a few other bits and pieces as well. And in that data itself, there's been some upside surprises. Now, I'm not necessarily sure that is necessarily positive for the long-standing health of the economy, because what it could mean for interest rate expectations going forward, but in the short term at least, it does suggest there is quite a lot of resilience. So of that data, the two that stand out is the GDP number for the first quarter and also the initial jobless claims number as well. And the GDP number came out at 2% for the first quarter. That was much higher than what markets were expecting, of around 1.3%. So clearly a very resilient and strong economy in that first quarter of the year, which works alongside the resilience we've seen in the labor market and is something that's going to come as a bit of a concern for the Federal Reserve. It doesn't want to kill growth in the US economy, but the more resilience it sees, then the more likelihood there is of persistent price pressures, which makes their job of getting inflation back to 2% all the more difficult. And then we have the jobless claims number, 239,000, which was shy of expectations of 265,000. Again, a good sign for the economy and the labor market, but not what the Fed wants to see right now. They want to see a bit more slack in the labor market. They want to see signs that the interest rate hikes are having an impact, that it's slowing the economy a bit, taking some of the heat out of the economy, which will enable price pressures to return back to more sustainable levels. They've also already made quite a lot of progress on headline inflation, but there's still a long way to go. And getting back from 4 to 2% is probably going to be the more difficult part of the task, especially on a core basis, with services inflation and other areas of that core number still remaining really quite strong. Now, today's numbers haven't had a huge impact on Fed interest rate expectations, but you can see that the collective of US data that we've seen more recently does mean that markets are expecting more rate hikes to come. In fact, markets are pricing in the next rate hike, a strong chance that that's going to come at the next meeting following the pause in June. So they believe that the markets believe that we're going to see that extra 25 basis points, and 85% chance that we're going to see an extra 25 basis points at the next meeting in July. But also there's a strong chance that we see another again before the end of the year. And what's also interesting is the markets don't believe we're going to see rate cuts this year again. That's something that was heavily priced into the markets even a month or two ago. And as you can see on this chart, the red line representing expectations a month ago, the orange line representing expectations now, there is a sharp difference between what we can expect now for the rest of the year compared to what was expected and how long it's going to take before we start to see interest rates falling again. But the more resilience that we see in the economic data going forward, the more I think we will see that orange line flatten, as we've seen over the course of the last month in the shorter term, and that could potentially harm the economy in the medium to long term. That doesn't mean that we are going to see that resilience in the economic data, of course, but if we do see it, then that is what you would expect would happen as far as interest rate expectations are concerned. Now, you can see here against the pound, for example, we have been trending lower over the course of the last couple of weeks. The pound has generally been quite strong against the US dollar and against other currencies, but against the US dollar more recently, we have seen the pair trending downwards. And I think that's partly a reflection of the fact that we have seen that stronger US economic data, that resilience in the economy, and higher interest rate expectations. But from a technical perspective, that brings us into a really interesting area around 125.70. That's where we have the 50% Fibonacci retracement level of the move from the lows of late May through till the middle of June. That coincides with a rising trend line, which actually dates back all the way to September of last year. And you can see the two touching points as well in May and June also. And also around that area, just below the trend line, you've also got the 55-89-day simple moving averages. Now, that would, for that to come into contact, we'd have to see a break of that rising trend line. So that would be an initial bearish signal potentially in the markets. But also the top of that 55-89 moving average band would coincide with that 61.8 fib. What this means is if we do see a break of those levels, that would suggest we could potentially see a deeper correction. It would suggest that the markets have become much more bearish on this than they have been over the course of recent months. And that could potentially be, like say, a negative sign for this pair. and a positive sign for the US dollar. If we do rotate off that 50 fib, that would keep the rising trend line intact. It would keep the pair above the 55-89 day simple moving average band, and it would suggest that the trend of the last couple of weeks has actually been more of a corrective move rather than a potential trend reversal. So I think that's going to be a really interesting and pivotal zone for this currency pair over the short term, and will tell us a lot about what people's expectations are, not just for the US dollar and the pound per se, but interest rate expectations across the two countries, and where we are going to see that stubbornness inflation and how central banks are expected to respond to that.